Picture this. You're about to make a very important decision in the markets, but there's a tight knot in your stomach and your mind is racing. Do you trust your gut or stick to your plan? This is where the psychology of risk management steps in. It's about understanding the psychology of trading, the emotions, the biases, and the mental habits and behaviors. In this presentation, I am going to share some practices and techniques to help you attain good, consistent risk management. So let's dive in. I hope you enjoy the presentation today. So what is risk management? Well, it is the systematic process of identifying and assessing and controlling your risk. It involves setting strategies, stop losses to control or reduce potential losses and protect your capital as much as possible. Again, this means setting stop loss orders and defining your clear entry points. So effective risk management is not just about reducing the chance of loss. It's about balancing the risk-reward ratio to ensure that you continue trading over the long term. So why is risk management important in trading? Well, I think it speaks for itself. But good risk management is very important for several reasons. Firstly, it helps in preserving your capital. It helps you to manage risk properly and ensure that a single loss doesn't devastate your entire account. Now, this preservation of capital is essential for staying in the trading game long term. Secondly, risk management contributes to emotional stability. When you know that your risk is controlled well by you and that you have a good trading plan, you're less likely to experience the stress and anxiety associated with unpredictable losses. Now, this emotional stability is essential for making rational and good decisions and to avoid those impulse actions. And having a very strong risk management strategy allows you to trade with confidence. Now, when you've assessed and identified potential risks, you're in a stronger position to stick to your trading plan. And this, of course, leads to consistent good performance. It helps you to avoid the common pitfalls of trading psychology, such as revenge trading or overtrading. So I really encourage you to reflect on your current risk management strategy. Are they helping you stay focused and control your potential losses effectively? Now let's explore the psychological factors that can influence risk perception. Have you ever noticed how your actions or reactions to taking risk can change dramatically depending on the circumstances? Now let's look at some of the key psychological factors that influence risk perception. More importantly, how they affect your trading decisions. So, risk tolerance. Risk tolerance refers to the level of risk an individual is comfortable taking. It's not just a one-size-fits-all concept, if you like. Every trader has a unique threshold for risk based on personal experiences and financial situations. Some traders may be more inclined to take more substantial risk for the chance of higher returns, whilst others might prefer to just keep it safe and protect their capital. Every trader's different. And understanding your own risk tolerance is highly important for developing a strategy which aligns with your comfort zone and long-term goals, of course. Now, risk perception involves how traders interpret and understand the risks associated with each trade. It's not always an objective assessment, but it is influenced by personal biases and even cognitive distortions. For example, if you've experienced recent losses, you might perceive higher risk in new trades, even if the objective risk hasn't changed. So being aware of how your risk perception can fluctuate helps you make more balanced and well-informed and good decisions going forward. Now let's look at a couple of common emotions. 2 common emotions: fear and greed. Now, we know that they're very common and most traders, if not all traders, have experienced fear. Now, we know that fear of loss can cause traders to avoid taking necessary risks. And over the years, I have met and worked with many traders who have got to the point where they just cannot execute a trade from fear of losing their capital or fear of failure. So on the other hand, we've got greed. Sometimes what can happen is when the emotions come in or there's losses, traders tend to overtrade, revenge trading, or feel that greed. Now, this can result in very negative results, as we know. So it's really important for you as traders to balance and manage your emotions and to be aware, of course, when they're coming in. So let's talk about uncertainty. Now, in trading, uncertainty is part of trading. And this can really lead to traders feeling anxious and hesitating. Traders may struggle with making decisions when outcomes are, say, ambiguous, often resulting in either avoidance or even overcompensation. Now, developing strategies to manage this uncertainty, such as setting very strong and clear trading rules, is going to help you to stay on track more. When you're clear about your trading plan, your risk management, it helps you to stay more aligned. So understanding the psychological factors that influence risk and risk perception will greatly improve your trading strategy and decision making, of course. So be aware, recognize your risk tolerance. Awareness is the first step. Have you ever caught yourself making a decision whilst feeling overconfident? You're not alone, it's common. So many traders experience this, and we're going to really explore some of the common biases that is going to affect your decision making around risk. Now, the first one is overconfidence bias. Again, this is really common. Overconfidence bias occurs when traders overestimate their ability, their perception changes. Now, it's easy to fall into this trap, especially after a series of successful trades. This bias is going to lead you to taking on more risk than you should. For example, after a few profitable trades, you might feel invincible, and this is where you start to take more risk. This overconfidence is going to result in poor risk management. So be mindful when this can happen. Now, the next one is loss aversion. Now, we know that loss aversion is a very powerful bias where traders exhibit a stronger preference for avoiding losses. This means the pain of losing is felt more intensely than the pleasure of potential gains. For instance, you might hold on to a losing trade far too long in the hope it's going to break even. This bias is going to prevent you from making good decisions and significantly impact your risk management. So again, it's about having that self-awareness, being really self-aware of your triggers, your actions, your behaviors. This is the first and most important step. So anchoring bias happens when you place too much importance on the first piece of information you receive, say for instance. This is going to lead to irrational decisions more often than not. And refusing to sell at a loss or sticking to outdated targets, if you like, this is going to be a problem. Now, to counteract anchoring bias, it's about striving to continuously update your analysis based on the most current information and trends. Next is confirmation bias. Now, these are all very common for traders, by the way. Confirmation bias involves favoring, say for instance, information that confirms your existing beliefs. This means that you ignore evidence that contradicts them. Now, if you believe that a trade's going to rise, a stock, you may just seek out positive news and dismiss negative reports. This is where your perception starts shifting and changing. To try and eliminate this bias, it's important to really seek out evidence to back your trading plan. This can help ensure a more comprehensive, a more balanced evaluation of your trades. And then next we have recency bias. If you've experienced, say, a series of losses, you might start to believe that the market is against you. Now, I've had many traders contact me saying that the market is personally against them. It can happen. Now, the recency bias leads traders to give, say, disproportionate weight to recent events when evaluating risk. So it's vital to recognize these biases: anchoring, confirmation, overconfidence, loss aversion, and confirmation, and recency. These can profoundly impact your risk management practices. But I'm going to share some techniques to help you with all of this. So let's talk about the emotional responses to risk. This is a big one. Have you ever noticed how your emotions shift dramatically during a trading session? One minute you may feel euphoria, the next you may even feel anxious. Understanding how your feelings influence your trading decisions is very important for you to improve and have good, consistent risk management. Now, fear and anxiety. I've talked many times about these emotions, but they're powerful. They can take over and cause traders to seriously go on tilt. Anxiety can make even minor risks seem overwhelming. Managing fear and anxiety involves being aware of these emotions and using techniques and practices such as breath work, mindfulness, meditation, and even hypnosis. These are all very good practices for you as traders to use regularly. Now, the next is stress, another emotional response that can significantly impact your trading performance. Not just your trading performance, but your life. High levels of stress can really affect the physical body, the mind, and well-being as well. So please, if you're a trader who is feeling stressed and burnt out, it's time to take a step back and have a break. Stress can seriously lead to overtrading or failing to stick to your risk management rules. So if you are feeling stressed, as mentioned, it's time to get some support to help you with this. On the other side, we have hope. Hope can also influence risk-taking behavior in a negative way. Now, while a positive outlook can be really beneficial, of course it can sometimes lead to taking excessive risk or holding on to a trade too long. Now, when traders are overly hopeful, they might underestimate potential risks or even ignore signs, believing and hoping that their trade is going to turn around and go for them. So again, it's very essential to balance hope with realistic expectations and staying aligned with your goals. Now, the next is regret. Regret is a very common emotion that it often follows poor trading decisions. The fear of making wrong choices can lead to, say, risk aversion, where you become really cautious in your trading approach and session. Now, this fear of regret can cause hesitation, missed opportunities. So to manage regret, it's important to develop a structured trading plan and stick to it consistently. Now, I know this is easier said than done, but there are practices and techniques to help you attain consistency as traders and manage risk very well. So all of these emotions can affect your risk management strategy and how you manage your risk. To stay on track with good risk management, it's important to explore alternative approaches that go beyond, say, conventional methods. Let's explore some strategies to help you combat self-sabotage and really manage yourself and really manage your emotions and your risk management. So the first one is a trading journal of reflection. Now, this journal goes beyond, say, common trading logs. It encourages traders to reflect on their emotional state and decision making. So by incorporating elements of mindfulness and introspection, traders can gain very valuable insights into their behavioral patterns, identifying triggers and self-sabotage. This reflective practice is going to help you create a deeper understanding of your psychology. So some other practices that can really help is visualization. Now, visualization is a practice that we have explored in a few presentations. But what you can do as traders is you can sit there and do even 10 minutes of visualization. Visualize yourself in a trade. See yourself really managing your risk well, making yourself proud, being accountable to yourself. More importantly, bring in the feelings and emotions of calm and composure, staying on track. So do this regularly. It's really going to start to reframe your mind, and you'll notice in your trading performance and your sessions that you're starting to manage risk better. So let's look at some of the strategies for good risk management. Every trader is going to benefit from having a very structured approach and mindset to managing risk. So, of course, develop a good risk management plan. This is essential for every trader, and every trader needs it. Now, I don't think I've met one trader in my 10-year career that has not created a risk management plan. So it's really important to do this if you haven't. Now, of course, this sets out boundaries. It's about setting clear guidelines and rules, and even for handling different scenarios, different market conditions. So ensure that you have a good risk management plan. And again, going on to position size, I'm sure you've all implemented this, but be very clear about your position sizing for each trade. How much capital are you willing to lose on each trade or every trading day? So this is really going to help. Now, this isn't relevant for every trader, but I suggest it strongly, and that is to use stop losses. Stop loss orders are very powerful tools. I know a lot of traders who jump into the markets, they're in a trade, the trade's going against them, and they will move their stop loss. Be mindful that this is very common, and does it work? Is it working for you? So that's something else to review. So let's look at a few techniques for helping you to manage risk better. I'm sure you understand that managing risk effectively now involves more than just strategies. It also requires a very strong psychological foundation. Now, traders can benefit from psychological techniques or mindfulness techniques designed to improve risk management. Here are some key strategies now. So the first one is mindfulness and stress reduction. Again, this is something I've talked about before, but if you practice mindfulness or meditation, it is not only going to help with your trading mindset, behaviors, performance, it's going to help you in life. It's going to help you to feel more calm, to help manage challenges, and to really find a sense of peace within you. So I highly recommend just set aside a few minutes each day for mindfulness exercises. And this could be anything from breath work, visualization, being in the present moment, the observer, or just guided meditation. And of course, hypnosis as well. Hypnosis is very powerful for traders. Now, the next, of course, is self-awareness, reflecting on the present and the past. Knowledge is power, as I always mention. So have you noticed any patterns in your behavior when you're faced with risk? Be aware of this. Self-awareness really involves you becoming the observer. Observe how you respond to certain market conditions, how you manage risk. Again, document, journal. It's really, really going to help you in the long term. So cognitive techniques can help you challenge and change thought patterns. For example, if you have a tendency to catastrophize or assume the worst case scenario, you can work on this by reframing these thoughts into more balanced perspective and positive thoughts. Cognitive restructuring or cognitive reframing involves questioning your thoughts. Are they serving you well? Do you want these thoughts? Challenge them. You're in control of your thoughts. Now, this shift in mindset is going to really improve your trading performance going forward. Again, the next one is visualization. How do you mentally prepare for your trading session? Do you set time aside to visualize how you want your life to go, how you want your trading day to go? It's not about the P&L visualizing this, but it's about visualizing how you act and react in trading and the sessions. So you can imagine both positive and negative outcomes and really start to hone in on your emotions, staying calm, in control, really balanced in your decision making. These are really going to help you as traders going forward. Now let's look at some of the resources. Let's explore some essential tools and resources that can help and really sharpen your risk management. Now, books can offer such good insights into the psychology of risk and strategies. So have you read The Psychology of Risk by Glynis Breakwell? This book really explores the psychological aspects of risk taking, and it provides such a good in-depth understanding of how psychological factors can influence risk. Now, the insights can help you to become more aware of your own risk tendencies. It's going to help you improve overall. So that's a book that I really recommend. Now, another good read is Against the Gods, The Remarkable Story of Risk. Now, this is by Peter L. Bernstein. This book again explores the historical development of risk management and how it's evolved over time. Now, he offers again a good look at the role of risk in various fields, including finance and trading. So, understanding the historical context as well and the evolution of risk management is going to help you to gain more knowledge and education. It's really going to help you going forward. So, I highly recommend these books to read, and I hope you enjoy them. So, as we come to the end of the presentation, let's briefly recap. We've explored the importance of risk management, understanding risk management, how emotions can affect risk management, and also sharing tips and techniques and practices such as visualization, meditation, mindfulness, breathwork. Now, again, I speak a lot about these practices, but they are so effective for traders. So if you have any questions or you need any support, I would like you to comment below and I will respond. I wish you a great week and I will see you next time. Thank you.